We've got Robert Howe here. He's joining us. He's from Geomatrix. Absolutely wild gyrations here, Robert, on these equity markets at the moment. What do you make of it all?
Well, the shock of the downgrading of the U.S. debt, it's been a perfect storm. We had growth slowing globally, signs of that. The AAA downgrading. Then in China and India, we've had inflation and policies against that. So it's not been a good time for markets now.
Do we come out of this soon, or do we expect this volatility to continue?
I think we came out of it on the day that that QE3 was basically announced by Ben Bernanke. Helicopter Ben fired up the helicopters again. So we see the action. The market sold off right afterwards. It's a normal reaction. Everyone thinks, oh, this is a dead cat bounce, sell into it. On technicals and other variables we look at, that was a short-term bottom.
Did you really think he has announced it?
No, he's saving that in case the market plunges. Remember, he started on December 18th. In 2009 with QE3, and you could just see the money supply go up. And then he had to announce it to the market on April 2nd because they weren't noticing it, and he hit them over the head with it.
Right. Okay. Will it work? That's one point. And does it disappoint you that there's a lack of imagination possibly here as well?
Well, there aren't that many options. But when you see fiscal tightening and slowing economies, and then monetary policy loosening to offset that, it's actually good for stock prices. It's good for gold, which is why gold is called asymptotic here.
Right. Okay. So they've tried they've got zero rates. They've had, of course, same time QE1, QE2. We've had ring fencing of banking, parts of banking debts, as well as, of course, these bank bailouts. You know, what is really left for them to do?
It is actually, the word quantitative easing is important. They have to actually go out and buy assets. Lower interest rates doesn't work. We're in a Japan situation for the U.S. now. We're entering that what's called a liquidity trap, where people don't want to borrow, they don't want to lend. But what works is actually printing money and buying assets, and that's starting up again.
And what about the underlying U.S. economy? Do you have concerns about that?
Less so. We think we were in a soft patch in the second quarter, and that's what people were worried about. All the numbers showed that. But that was due to a couple of things: very high oil prices and the supply disruptions out of Japan, and that's out of the way. Oil's down closer to $80 a barrel, and Japan's back up and in business again.
But do you take any? I mean, we saw the trade surplus in China. I think it's the widest trade surplus we've had there in 2 years. That perhaps indicates something about demand, and demand from the U.S. in particular.
Yeah, we don't believe we're going into a recession. It was a normal slowdown. It was similar to last year, and you're getting the same sort of panic we had last summer: sell in May and go away. But combined with some of these other things, the problems of debt ceilings and the beginning of the Great Reckoning, which is the end of the debt super cycle.
The Great Reckoning. Yeah. Tell me a bit more about this.
The Great Reckoning is a book from about
The Great Reckoning, sorry.
Great Reckoning is a book from 30 years ago. It was 30 years early, and it just said that the debt super cycle will end in tears. We're seeing that happen, first in the peripheral European countries, and there's concern about the U.S. coming up against some sort of debt ceiling that isn't mandated by Congress, but is actually mandated by the bond vigilantes. And the bond vigilantes attacked Europe last night, particularly France and SocGen.
Yeah, I mean, what about France? I mean, wasn't that unwarranted to some extent?
I think so, but I think a lot of players were short SocGen, and they circulated a couple of rumors, and the stock at one point was off 23%. They've covered and have moved on.
Okay, well, let's also just talk about what's been going on in Spain and Italy, too. I mean, how does this play out for Asia, and what does Asia need to look out for?
Well, there are banks that hold some of the paper of these countries, but really it's about a trade slowdown. I'm
not going to name the bank, but I was talking to a senior official at one of them the other day who was saying that they are a major institution and they were cutting off as much of the linkage as they could with European financial institutions. Do you think that's something that a lot of people have been doing here?
I think they've been doing it gradually, yes. I think there is less linkage here than, say, there are in money market funds in the United States, which is where you worry about it. But I was just in a meeting with Hang Seng Bank, for instance, and an analyst was grilling them about their holdings of U.S. Treasuries and when they were going to mark those down. I mean, I went back and started buying the market at that point. When people are grilling, major institutions that you're going to have a major downgrade because you're holding U.S. Treasuries, I think that's taking it a bit far.
Yeah,
There's a lot of fear in the market.
Yeah, And, you know, the fear doesn't go away. If anything, it's just getting more skittish, I'd call it, actually.
Yeah, well, we've had the VIX spike up, and
It's up 22%.
Yeah, 5 out of 6 times when the VIX has gone over 44, it's been a buy opportunity. Now, the 6th time, of course, was 2008, and that's what's fresh in everyone's mind. They touch that hot stove, and they don't want to go there again.
All right, well, what are you buying at the moment?
We're actually buying a whole list of stocks. We haven't had much exposure to stocks in Asia recently, but we've been buying in Japan and Hong Kong, and then finally a little bit in Korea. Korea's really fallen off a cliff the last week. Now, we were a little bit early in the performance anxiety of fund managers. We call this premature accumulation.
We won't go there.
And we just kept buying into the sort of epical falls this week, and we're happy with some of these positions. PERs are at hit record lows, and a lot of people wring their hands and say for a recession it can go lower. Well, that was the same argument in February 2009.
Some people are even using the D word at the moment.
Yep. Yeah, and we just don't see it. I mean, Cisco reported earnings overnight. They surprised on the upside, and a lot of that was cost cutting.
Yeah, because we're seeing top line growth. It's not bottom line and cost cutting, which is responsible for the earnings growth, are we? This is the fact. This has been the characteristic of the earnings season.
Yeah. We are seeing the signs that we were seeing in August was that the U.S. economy was actually picking up again after that slowdown. Now there's this reflexivity of fear. People are watching this program and other programs and watching their 401k become a 201k, and I'm saying, well, maybe I'm not going to get that iPad for my back to school after all. So that's the concern, is the feedback mechanism, what Soros called reflexivity. So we're pretty sanguine about the economy. Other than that,
give me some of your names.
We've been adding, our biggest name was Fanuc, which is over 3% of our portfolio. It's a leading automation play on China. We've just been buying recently a company called Rinnai, which makes water heaters, and it's having to rebuild the northeast of Japan and also moving into
As we move
China.
into the winter, that's what you're looking at here.
Yeah.
But will there be the electricity to power them?
Yep. Well, no, they actually make kerosene heaters, which is one of the things. So, and it's a very high-quality product. There's a lot of concern in China now about quality, right? All kinds of things, trains, low-end housing, is this quality? And a lot of Japanese companies have an edge in there. They do make very high-quality products.
So when you look at China as an investment opportunity, do you actually see the companies which are perhaps a bit higher on the value chain as being the next big players?
Yes, within China.
Yeah.
Yeah. I mean, we, like a lot of strategists, we like some of the consumer plays in China, and those had been too expensive for us in the sell-off. We've been adding to those, like Belly International, a shoe retailer that's moving into online sales of shoes, which has been a great model for someone like Zappos in the U.S.
Right. And anything else?
Oh, let's see. In Hong Kong, we've had our biggest position is AIA. I used to work there. I think it's a great insurance company, emerging from the ashes of AIG, and the premium growths are excellent. We also own PIC Property and Casualty. They were sold off because, oh my goodness, they own U.S. Treasuries. And lots of hand-wringing about bonds that they hold. Okay,
I noticed from your notes that you say that stocks move on the third derivatives of earnings. Now, I couldn't work that one out. You have to explain it to me.
Well, it's all about expectations, right? That's the market is a discounting mechanism. So there's earnings growth, and then we look at something called earnings revisions, which are the analysts' changes in their expectations of growth. And then it's actually the acceleration of those changes that we look at. So, and it's actually was turning positive for lots of markets in the U.S. The strongest were the U.S. and Japan, and that's why our biggest position was in Japan.
I think we've hammered Europe enough. I mean, the question is we just don't know what's going to happen in the next 6 to 12 months with the European community. But I want to ask, maybe take a step back.
What's going to happen in a month?
I don't even know what's going to happen in the next 10 minutes, but, you've seen a number of market declines. This isn't the first one that we've been through. We saw Lehman Brothers. We saw what happened in the 90s. We saw what happened in the late 1987. How would you compare the correction that we're seeing now? Or, let's just call it a crash because the percentage terms indicates that amount. How would you compare this decline to the other market declines that in the past?
Everything's speeding up. I mean, not just in markets, but in
velocity,
everyday life,
the
right?
speed.
Yeah. Well, I mean, we've just come through 2008, so the learning mechanism of any organism. It's whatever just happened.
We went through 2000. This feels much faster in terms of the market decline. Is it now? A lot of folks are blaming computers for this.
I think no, it's not computers.
Then.
It's not
computers.
It's not. They had computers then. What you have now are people have learned from their mistakes, and they have tight stop losses in all their positions, which just compounds it. And these are normal people, and they have accounts that are online, and they just set the stop loss, and it just executes even if they're at the beach.
What do you mean by faster? Let's get into definitions, because are you saying that the losses have come faster, the confidence has come back faster? What do you mean by faster?
Well, both. I mean, I think the confidence, when you get this much volatility, the confidence of all investors is shaken for a little while, and it's like in engineering, if you take a tuning fork and bash it, it oscillates a lot, and it takes a long time for that to stop, and that's what we're seeing right now. But what I'm referring to is yeah, you have the very fast computer trading programs, but even individuals now have stop losses. Their advisory services send out a notice that we have a trailing stop. Investors Business Daily, a leading newspaper, has done this for years, but now it's widespread, and you can do it online with your Fidelity account or your Schwab, your discount brokerage account, and it happens even if you're at the beach.
Yeah, Robert,
the stock is sold.
The thing is also, I guess when we look at, as Phil was mentioning, all the various crises that we've had, they've had something actually very tangible. This is just background noise. This is something, how do we actually digest a downgrade for the U.S.? It's uncharted terrain. It
is. Whereas in the 2008, you could measure the drying up of liquidity with something called the TED spread. And people were looking at that, and it blew out to 430 basis points, and it just showed that money was not moving in the system. That's not the case now, but it is. It's a great deal of uncertainty. As I was saying earlier, I was in a meeting at Hang Seng Bank in which an analyst was hammering the CFO about his holdings of U.S. Treasuries, because people just don't know. When are you going to write those down, and who are you lending to who holds U.S. Treasuries? Well, everyone.
Yeah. But what happens? Did the Chinese write down their U.S. Treasuries? That would be quite something.
So yeah, there's a little bit of irrational fear in the market.
Well, the Treasury prices have gone up. The yield's gone down, and Treasury prices, I mean, they've made money on the downgrade in effect.
Flight to safety, yeah.
I want to mention a little bit about sort of the Hong Kong markets specifically. I guess it applies to all the markets, but when you look at the trading that's occurring right now, how much of it is institutional trading? How much of it is retail investing that you're seeing out there?
I don't know the numbers, day by day, but I think in Hong Kong, it's typically 2/3 institutional, 1/3.
Now, why are you asking?
If you look at the markets here, well, after Lehman Brothers, when it blew up, a lot of traders got shaken out. And the market didn't even hit bottom until, 6 months later. So the initial fallout in September and October of that year, that wasn't the bottom. That was actually a false bottom. Then the government stepped in and it bailed out sort of the private financial institutions. And we didn't see the bottom of the market until 6 months later. Is this a scenario where you step in now to say, hey, I think the prices are cheap enough and you step in, or maybe you need to wait a couple months, sit back until let the dust settle?
Could be what Robert was suffering from before, which is premature accumulation, I believe.
That's what we did a little bit of. We waded in and started buying some stocks at the end of last week. It was a little bit early, and we just continued to do so this week. If stocks get down to a low enough value, you might have to wait for a month or two, but we're happy to own more AIA. We're happy to own the social networking companies
but
in
as
Japan.
Phil's suggesting, I mean, you've got to be careful here as to, have we seen the low here? But the thing is, you could almost predict what was going to happen on Monday and Tuesday and then see the move up and then say, hey, there's going to be another leg down. It was actually, I was talking with a friend of mine who I'm not going to name, but he got it absolutely right.
Yeah. Well, let's talk about 3 or 4 concrete things that we look at that we think a bottom has been put in. First of all, the VIX, the volatility index, spiked to over 44, and then it went through that again. 5 out of 6 times since that's been in existence, that was a bottom. Of course, that one time was 2008, and everyone is remembering 2008. We don't think it's a 2008. Another is, I spent a lot of my time in Japan. It's called candlestick charting, and what you had was, in candlestick terminology, an engulfing pattern on Tuesday in which the markets, the candlestick just engulfed the bearish candle, and it was not violated last night in the sell-off. So
let me interrupt. I sense you're bullish here. If we were clients, you would tell your clients to step in at this point. Is that an accurate statement that you're bullish right now at these levels?
Yes, at these levels.
I want to know about redemptions. This European fund manager, I spoke to yesterday, said on the retail side, no redemptions so far, so there's no panic on the retail investor side. And neither did Kim Do of Baring Asset Management. Does that show that there's a little more confidence this time around? Because 2008, people were just lining up, trying to rush to cash out, basically.
Yeah, I think so. And one, I don't think people are fully committed to equities as they were before. They've been gradually getting back in. And so it isn't a matter of being wiped out if you're with a fund manager and the account is going down. They'll have money in other places. Most people have been putting money into gold, for instance, and so they're probably more diversified than they were at the end of the equity culture in 2007.
Yeah, but you hear about all this money on the sidelines still. I mean, at what point, what needs to happen before people will get back in? Are they just calling for stimulus? They want a QE3 package before they say, all right?
It's the buying of assets by helicopter Ben that triggers those assets. And it's not low interest rates. That's a liquidity trap. It's buying of assets. That's what quantitative easing is.
Number 19 is chocolate.
Yeah, we're pretty much back to those levels, though, in September 2010. So I don't know how much of a difference it made last year. All right,